Special guest here today. We've got someone who's got a very, very unique pedigree and background that's going to give us some insights to driving value, raising venture capital dollars, and a lot more. Everyone, please welcome to the show the CEO and founder of Neighbor. Did I get that right? There, Joseph Woodbury.
Yeah,
Yeah,
thanks for having
excited
me,
to
Craig.
connect with you today. We got connected through a mutual friend, Taylor Oliver. Those who know the Lone Star team and family, his brother, Brad Oliver, is our director of acquisitions. So we'd like to keep things tight knit here. So no exceptions with this here today. That said, Joseph, would love for you to kind of get into your background and as to how you got here. You've got a very unique product, but maybe just starting from your origins, from perhaps growing up where you did that, and then kind of background, and then how you kind of stumbled into the business you're in today.
Yeah, so grew up actually just outside of Vegas area in Nevada, and eventually made it here to Utah, where Neighbor's based, Salt Lake City. Came to college here, went to BYU, uh, hoping for a big win here today, March Madness kickoff day, um, and was really headed on the professional services track initially. Worked for an investment bank and then a private equity firm, and then ended up at a consulting firm called Bain and Company. Didn't what wasn't super familiar with entrepreneurship or tech companies or anything in that field. But my senior year, a good friend of mine approached me and had the idea for Neighbor. We started working on it, and it started getting traction. And by the end of our senior year of school, we both called our full time jobs and told them we weren't going to show up and started
Yeah,
Neighbor
and Bain
instead.
Capital, is that correct? Okay.
Bain and Company, actually,
Would
the
that be in
consulting side.
relation to Mitt Romney? I would presume.
Yeah, he was one of the kind of first founders that started Bain and Company, and then he came back as CEO later. But by the time I was there, uh, Mitt Romney was long gone. I think he left in the
Right, makes
late
sense. And then had
'90s.
his political career and such after that. Well, very cool. I appreciate the background there. And, it's funny, you started with the more traditional way, and then the entrepreneurial spirit and bug obviously bit you. So let's get into that right there, neighbor. What is the product? What's the kind of the idea behind it? How did you maybe, how did the kind of the origins of that come about?
Yeah, so Neighbor's the largest storage and parking marketplace in the world. So what essentially the product is we allow people with extra space to list that on the platform and rent it out for parking or storage. We actually started on the residential side, so very Airbnb style, allowing homeowners to rent out a garage or a shed or a driveway to store their neighbor's boat or their car or their boxes. And we grew that nationwide. We grew that to having homeowners in every city in the country. And then we started working on the commercial side as well. And so now we work with most of the large commercial operators in the country, owners of multifamily, retail space, office space, a lot of large billion-dollar REITs that list their properties, maybe a large parking lot, a large storage area, and we drive ancillary income for those
Excellent.
portfolios.
So I guess on that side of things, how do you work, or I guess on maybe before we get to the commercial side of things, so how does one kind of list their property there? What's the vetting process like from you all to onboard a, potential, person who would want to be rent, someone, the owner of which, how does that kind of process work?
Yeah, so if you're just a homeowner, there's a pretty simple online flow that you can go through. We're going to ask you a lot of details about your space. Where is it located? What amenities does it have? Is it, closed off? Is it climate controlled? Is it secure? Does it have security cameras? Things like that. And then you'll go through a vetting process. So once you submit your listing, every single listing on our platform is actually manually reviewed by a human. So we are we are vetting everything that gets listed before it gets listed. We do ID verification for our hosts. We make sure they are who they say they are. And then if you're approved, then we list you on the platform. And from there, we kind of take everything. We find you a renter, we process the payments, we help them get in your space, et cetera, et cetera. And is very passive income. It's, you think about other marketplace options like Airbnb or DoorDash or Uber, they require a decent amount of work. You have to go drive around to earn any money. Whereas Neighbor, I actually rent out the RV pad on the side of my home, and I have one of my neighbor's camper trailers stored there because I don't have an RV, so I don't need it, and it pays my utility bill every month. I basically don't pay for utilities because my neighbor pays for it for me. So it's great passive income. I don't do anything every month to earn that
That's
income.
really unique, actually, because I'm thinking to myself about truly passive income, right? Like I think so often people think, "Oh, I'm going to buy a rental property, right? And I'm going to manage it myself." Well, that's
Right.
not really actually that passive. You're going to have stuff break, things are going to go on.
No.
It's not really streamlined. But for what you're kind of alluding to here, then even if you do an Airbnb, that's actually very hands-on. You still are coordinating through manager. You're still doing updates, this, that. But it sounds like what you do is you basically streamline the process. And then do you go through a vetting process there at that point, depending on the space, as to what you would feel comfortable with renting there? Or they give you the options. Let's say if someone inbounds, you review the space, what could potentially fit here, right? Is that kind of how that goes about?
Yeah, so you as a host, you get to decide what you want to allow at your space. So let's say uh, you're a multifamily owner. You own 50 properties nationwide, 50 locations. I don't know how many doors that would be, several thousand doors. Um, and you have certain properties that have different restrictions. Maybe you have one that's in a metro area that has a height restriction, whereas another is a garden style and it's in a community where you could take anything. You could say, okay, we only want vehicles to be stored at this property. We don't want to allow boats or trailers. But at this property, we're okay. We just want to maximize earnings. So as long as it's in the back, kind of out of sight, you can store anything there. And so you can really customize what you allow by property. And we pre-vet that for you. So the renter has to describe everything that they're going to be storing. And we will block off your listing so they can't reserve it if it doesn't match up to your requirements. Furthermore, you actually receive that list. And so you'll know ahead of time everything that we've approved them to store there. You'll have a full list, and if for whatever reason you had questions, you could ask those directly to the user. We have an on-platform messaging service, so you don't. It makes it very simple to send them a quick message and ask a
That's
question.
incredible. So then let's talk about typical duration of time there, right? So does that vary per person? What does kind of the data and analytics say with regard to duration? Is it shorter term? Is it long term? Does it vary? Do you kind of know the process there? Like, let's say if someone wants to park a boat there. Well, naturally, I would imagine if they find a nice kind of garage for it, a nice space for it, that they wouldn't really want to move that. But traditionally speaking, how long would you say the average space storage amount is used for residential property as opposed to commercial, and maybe the ticket size per property?
Sure. Yeah, so duration tends to be longer term. That's part of what makes this passive. We've surveyed some of our property managers that we work with, and our average property manager is spending about 15 minutes a month on this because, again, it is long term. Most of their job is meeting with the person on the day they move in and handing them a key fob or a scan access code so that they can get into their parking space. But beyond that, the person kind of just stays for a long period of time. You do. It is all month to month, so you're not signing any sort of long-term contracts with these individuals. A lot of our owners really like that because it gives them flexibility to try this out, and there's really no obligations. Within 30 days, you could have everyone off. If for whatever reason you need those storage spots or those parking spots back, you can have those back. It turns out that the income's pretty addictive, so for our purposes, we don't really mind that it's month to month because once people start getting this income coming in, they almost never remove the spaces from our platform. But we do have, some large owners they don't only have the properties they've built, but they also do land banking, where they may own some lots that they plan to develop on 5 years from now, and they'll list those lots on our platform as well, and we'll rent those out for long-term parking and vehicle storage, even though they know that 4 years from now I'm taking this property off of Neighbor because I'm going to build on it. It's quite easy because it's month to
Yeah, that's
month.
actually a brilliant idea as well, because for those who may or not be familiar with kind of holding costs and whatnot, it's not free, right? Particularly if you've got a large space,
No.
depending on where it is, depending on the state that you're in, you might have massive property taxes coming in. It's basically just a big liability. Not every place is like Arizona or Oklahoma where ownership costs are very cheap. You get to a lot of places like Florida, like Texas, like California, and New York. If you were to acquire a property today, it would be quite expensive. So to kind of be able to offset some of your costs there and basically maybe even just to hold it, and maybe even if you can break even, well, then you're actually more than just breaking even, you're getting paid in appreciation, because obviously everyone knows land value and land generally just trends up. Obviously, sometimes it's cyclical in nature, but they're not making more of it, right? So being able to get some yield out of kind of a blank space is quite productive. What,
Yeah, that's typically our pitch is we say, just make this a break-even opportunity for you. We'll pay your property taxes essentially while you're waiting to
Yeah,
build
that's
on this.
incredible. And then you can get zone, entitled, shovel ready. So that said, where have these land plays in that setup been most fruitful and productive from a kind of return perspective? Because I imagine if you're too far out in the kind of the sticks there, if you will, there's not enough traffic where it might be inconvenient. But if you're in a nice, maybe garden style area, you might put some more units, or there's a nice, metropolitan area, or there's a nice, 100,000 people in the local vicinity that could create a market, right? So what's kind of the sweet spot for those land plays?
Yeah, so you're right. It definitely depends by market. I'd say in general, though, Neighbor has a lot more demand than we have supply. We'd consider ourselves to be a supply constrained business. To give some data on that, we have millions and millions of renters that come to our website every single year that we're unable to service because we don't have the right supply for them in their area. So, on average, if you have a property, we're going to be able to find renters to fill it. And I'd also note that, again, we have properties in every city in the country at this point. There's cities with 2,000 people in them where we have hosts renting out property. So this can really work anywhere. That said, of course, property in urban dense metro markets is going to be very desirable. And if you look at our largest markets, the markets like California, New York, Florida, where there's just a lot of traffic being driven to those places, we can fill them up quite quickly. Um, One thing we can do, and one thing we do with all of our larger partners, is if you meet with our team, we'll actually give you a specialized team that specializes in your asset class. So if that's multifamily, uh, we'll set you up with a multifamily team, and you can give them a property list of all 50 of your properties, and some details about how many storage units do you have at each property, how many parking spaces in excess do you have at each property, and they'll go run that through our system, our pricing system, and our demand system, and they'll create almost a heat map for you where they'll say, okay, of your 50 properties, these 10 are going to perform the best. And so we can provide recommendations. Oftentimes we'll start with those 10 properties and do a pilot where you can get used to the system and have a good experience earning that income. And then if you like it, you expand to the other 50
Makes sense. And
properties.
I can imagine right now, particularly when revenues for a lot of operators is down, when rents are maybe staying stagnant, and you need to figure out ways to kind of keep your property from being, below water, or, make those payments, finding out an extra stream of income that you didn't have before, that you weren't maybe initially underwriting, is massive for a lot of people. And that's probably a part of the ancillary income item on the revenue section for your NOI that you could potentially sell to the next owner. So that's a very fascinating time when we're talking about highest and best use of space. This product seems to be a seamless fit for someone like that who's looking to grow their the revenue stream.
Yeah, we work with several major partners, even publicly traded REITs who their largest source of growth right now is ancillary income because rents are flat to down. with more supply coming on, I think this is a trend everyone's paying attention to, the amount of new builds happening in the country. Everyone's saying that it's going to slow down later this year and that maybe rent growth might return next year. But as all of us know, if there's a belief that rent growth is going to return next year, then people are going to start building again. So competitive markets have a way of driving that rent growth down.
Certainly. So that said, let's talk about how you interface, integrate with operators. So, let's say a group's got, a property or two. Maybe they've got a big portfolio. Take a group like Lone Star Capital. We've got currently to this moment, roughly, I want to say 22 properties under management. Let's say, a group like you inbounds to
Yeah.
us. We do, typically speaking, multifamily property in Houston is kind of our biggest market, places in Dallas and in San Antonio. But how does a group like us, work with someone like yourself? Can you kind of talk through that process there? Typically speaking, just so our asset classes is garden style multifamily, not in kind of super downtown areas, but kind of, in good spots with good freeway access potentially.
Yeah. So like I mentioned, we would have a meeting to get to know you, get to know your priorities, and get to know your space types. One of the first questions we'd be asking is, uh, what is your mix of, parking to unit ratio? Also, do you build storage as an amenity on site? Many multifamily owners do build that storage as an amenity. It tends to be pretty low occupancy. A lot of times we'll go check things out and like 30% of the units are occupied, because the tenants just never use them. And so we'll take those 30%, we'll get them to 90% through the community, and so that you're earning on every square foot of your space. And oftentimes there's a little work to be done on the multifamily partner side, because they'll they'll say, you know what, we don't really know what parking looks like across our portfolio. It's not something we track well. It's not in our CRM. We know to a T what our unit occupancy vacancy looks like, and we know everything there is to know about our apartments themselves, but we don't keep track as well of those storage spaces or those parking spaces. So oftentimes they'll go do an audit of that. One of the most common lines we hear when we first start working with a partner is, oh, I don't have any extra parking. That's a problem. I actually don't have enough for my tenants. And what we find is that while that does end up being true on some of the properties in a portfolio, many times when they actually go examine parking, they'll find 5 or 10 spaces at each apartment complex that aren't being used, and that's all it takes is 5 or 10 parking spaces at each location to drive a very material amount of rent across the portfolio. The way we think about it is every 2 to 3, depending on your market, every 2 to 3 parking spaces you're able to find is like adding another door to your portfolio, because it's straight NOI. You look at gross multifamily rents, and gross margin on that is in about 20%, I think 20-25%, by the time you get to NOI. Whereas this revenue we bring on, it's 100% NOI. There is no margin on it. And so when you compare NOI to NOI, every 2 or 3 parking spaces you add is like adding a new apartment unit to
Yeah.
your
Well,
building.
also,
And so we'll go do that
yeah, I was
audit.
going to say the interesting thing about that as well, sorry to cut you off, that kind of gets my brain tingling here is the fact that the turnover and the make ready on something like that is non-existent. It's a parking space, right? One of the biggest things that any operator is looking for,
Right.
particularly right now, is getting a rent bump. That's nice and all, but keeping your tenant there and happy and not having to do a turnover. Turnovers are a big drag on your business. For those who don't know what a turnover is, that means someone rents a unit, and let's say they've been there for some time. Maybe they beat it up, but you got to repaint it. Maybe the fridge is messed up. Maybe the dishwasher's messed up. Maybe there's a potential problem with that property now. Well, now that is time on your management team. That is time on your leasing team, all these things going through this to basically accommodate a said, problem there, right? So for someone to, be able to do that and turn things over on a piece of concrete, well, obviously it's harder to ruin a piece of concrete, likely won't happen as opposed to a unit.
Yeah, it's very safe, a very kind of maintenance free. And even these storage cages on the inside that owners will build are, it's chain link or it's a garage. There's not much you can do to that space. There's no plumbing. There's no any of these things electrical that break all of the time. And so once you've done that audit and we've helped you determine your earnings, we'll give you an earnings estimate of like, here's how much you'll earn off of each property, and we determine which to go live. It takes a day or two to get those live, and a day or two more to start getting you your first renters. So it's very quick. Once you make the decision to push the pilot live, it's very quick time to revenue. And we can give you pricing guidance. We have the best pricing data of any storage company in the country. We're the only storage company in the world that operates in all 50 states. Not even the major storage REITs operate in as many states as us. So the pricing data we can give you is very, very granular, like to the block on what you should be pricing at. We can actually help you better price your parking spaces for your existing tenants if you'd like us to. That's kind of advice that we offer. We don't manage those spaces at this time. We just manage the extra spaces that you give us. But we're happy to provide advice there on a pricing basis. We probably work with many multifamily apartments near you. If you look at the list of the top 10 multifamily REITs in the country, we probably work with well over half of those. So we have good data that we can provide.
That's excellent. So what I'm kind of thinking as well is I can imagine if you are a sponsor like us, is buying garden property, there's some properties that are really tight on their square footage. There's some properties in their acreage, right? There could be, hey, you could do a podium build property. Well, there's likely not additional square footage around that's underutilized potentially, but maybe you've got some covered parking potentially that could be of value to said, customer like yourself. But we actually have a property in Dallas that has a lot of acreage, and it's not probably fully optimized in that sense. So have you seen operators kind of add additional kind of concrete parking to their, I guess, property to accommodate said extra income item? Because a little bit of concrete and grading, and particularly if you've got, vertical integrations like us where you have construction management in there, that's not too, difficult or challenging for them to add that. So have you seen kind of people do that? And then if they do that, do they typically add, or is there a feature to add kind of covered parking? Because particularly you get to places in Texas, storms definitely happen. No one wants, a hailstorm, just, putting dents, when you've got golf pole size hail balls on their cars with their product there, right? So do you typically, kind of get a better premium if it's covered, stuff like that? I know it's a lot I just threw out there, but I'd be curious to know the answer.
Yeah, so to your first question, do we see people making capital improvements? We absolutely see that on a platform. We actually recommend to the people we start with to not make those capital improvements, to just list space as is, and then to turn around and use the earnings from neighbor to make those capital improvements. So let us help you fund those capital improvements. But we do see those improvements happen over time. To your second question, yes, there are premiums that are commanded for indoor covered parking. And we can show you that delta. We can show you, okay, here's the price that you can charge if it's uncovered. Here's the price that you can charge if it's covered. And so you can run a very clean, simple model to say, okay, is that premium worth the capital improvements that I'll make to the space? We've even seen people go further and actually put storage units or sheds on the property, because that's always going to earn a higher cost, a higher price per square foot than parking will, is that actual indoor storage space. So we've worked with some major multifamily owners that have properties where they've built as much as hundreds of units right next to their multifamily property. And of course, the tenants do not fill those up. There's just not enough tenant demand to fill those up. So then we rent those out to the community quite successfully. So And you see this on I mentioned, you see this on the residential side as well. We'll work with um, single family rental owners that maybe it's just an individual that owns 10 rental properties, and they start using us at their properties. We'll earn them $300 a month extra at each property, which is great on a net basis, especially if you think they're only earning
That might be their
$300
cash flow,
net
right?
on
Yeah.
each property. Right. But then as they get addicted to the income, they'll start to do the calculations, and they'll think, okay, if I go buy another townhome in Salt Lake City, that's going to run me 500 grand, and I'll maybe earn, twenty to $30,000 in annual rents off of that property. But if I use that same $500,000 in capital and instead I bought a acre to 2 acre lot in Salt Lake City, I would earn around $100,000 a year in rents on neighbor. And they just abandon single family homes and they start investing in dedicated neighbor properties because the yield is so much
That's
higher.
amazing. So it seems like kind of a big win there. And, the other thing that kind of peeked into my brain there is exactly to your point about the self-storage thing. Storage is very interesting. For those who,
Yeah.
might not be privy to this or, the market, it's really exploded. And I think a lot of the reasons why it's exploded is there was so much migration, so much movement, particularly during COVID. Storage is not some new asset class. Of course, everyone's seen public storages all throughout any neighborhood throughout America, right? Obviously, you work with, I'm sure, public storage all the time. But you look at kind of stuff like that, storage. Well, let's just talk about the logistics of storage. In most cases, it's four walls and a roof, just like industrial real estate. Industrial real estate and storage, guess what? Unfortunately, for the better or worse, it is very easy to build that and to add that, which can be challenging. It's obviously beautiful because it's so easy to build, but the other side of that coin there is naturally, well, when you've got storage like that, it's easy to build and add. But that said, for this instance, if you could build 20 storage units on a piece of land that wasn't doing anything and you can add that, that will pays for itself, but also you'll be able to add your NOI, which helps you sell your property at a higher multiple from a capital perspective down the road, which is obviously very beneficial.
Yeah, we follow trends on distress rates across industries. And if you look at all of the different verticals, office, retail, multifamily, uh, mixed use, self-storage, hands down the healthiest vertical right now is self-storage, has the lowest distress rates of anything. And we've started using this term full property monetization to describe this, because I think in the past people thought in a very siloed manner, this is my expertise, this is what I'm good at, I'm really good at retail, and so that's all I do is retail. Whereas I think the owners that are winning now are those that are a little more creative, because you have to do something to create a competitive edge. There's a lot of capital out there. So what are you going to do to be competitive? And I think the people that win are the people that look at a property and they say, how can I monetize this property? How can I monetize this property to the fullest extent? And I'm agnostic to asset class. I don't care if it's office or retail or multifamily or a mixed use of all of them. And we're seeing that more and more and more, that people are increasing their yields by mixing across assets. So if you can get a stable income source, like you've seen in storage, you may have friends that own storage and you may be envious of kind of the stability of those cash flows. You look at the large REITs and some of them have like 50% net margins, just crazy amount of cash flow coming out of these, and they're 90% occupied nationwide. The industry spends about $5 billion a year just on new construction, and they're still 90% occupied. There's just a lot of storage demand out there, and you might as well take advantage of that and have that steady income stream, so that when cyclicality happens, which it does in multifamily, we all know that, you've got a hedge, right? You've got something that helps you pay those higher interest rates when your term loan comes due. And if you can be one of the people that holds on to their property and is able to manage it profitably during a downturn like we're going through right now, well, then you're going to look like a genius on the other end when things start to rise again, if you held on
Yeah,
to
what
that
I'm really
property.
thinking about right now is okay, take a strip mall owner, right? Well, what if you could just take cover, maybe add a little covered parking, and now you've got car and parking spots there that are utilized, where if you're not getting enough traffic, that could be a way to do it. And then the other thought I had is, it's so funny that we're having this conversation, because how many times, and if you're a capital raiser, if you're an LP investor, you're going to laugh at this, but over the last 30 years, commercial real estate has become substantially more institutionalized, meaning more, smart dollars, pension funds, REITs, billionaires, you name it, high net worth individuals have flooded into the space because it's such a good product. Now, that's a good thing because there's more liquidity than ever, but it's probably going to shrink your returns and make things a lot more competitive. And what that does is creates a very difficult process for those to actually have a scenario in which they can truly create a lot of ancillary income value. Why? Because smart people are implementing the same tricks over and over again. You've got the tech package there. You've got the covered parking at a premium. You've got the reserved parking. You've got washer and dryer hookups, right? These tricks had kind of been done on properties to this point. So it's very challenging to kind of reinvent the wheel and add another layer of income to these properties that have already kind of been maxed out by the smart people in the industry. So be curious to know what your perspective is on that, because I'm sure you see that often where, it's just not easy to do the next thing in line to create that value.
No, that's exactly right. We for a multifamily owner, we all have access to the same data. Everyone generally knows. You go back 20 years, you may have had to do a market study to really figure out what the market rents are. But these days, you can go on apartments.com or a number of different websites, or you can subscribe to a data feed. Although I think there's some antitrust issues going on right now with RealPage and things like that. But we all have access to the same data. So everyone knows what the market rate is, and you're not going to outperform that in a meaningful way without something that's probably pretty costly from a capital expenditure standpoint. So if you want to outperform, if you want outsized returns, you have to look for something that you haven't heard of before. Because if you haven't heard of it, likely the multifamily complex down the street has not heard of it either. And that's not just Neighbor. Neighbor's one use case there. Neighbor's one example of something you could add that's fairly new to the industry that the most creative people are doing to gain an edge on their returns. But there are other options out there as well right now. I think most people have at least been pitched at this point on kind of package delivery. I think the cable networking stuff is starting to get maxed out.
Bulk
People
Wi-Fi,
have
cable
had enough
packages, stuff like that. Yeah.
bulk Wi-Fi. So you're looking for that next thing. 20 years ago, that may have been a new concept, but someone was the first to try that out. Someone was the first to do that, and they're the ones that had the highest returns, at least initially. So what is that next bulk Wi-Fi? What is that next, mail delivery service? What is that next Neighbor? That's what you should constantly be looking if you want to have those outside
No, I couldn't agree with
returns.
that more. And I just go back to the thought, and my friend and I laugh about this all the time. But if you were a market expert back in the day and you were really smart, you could run laps around people, because not the most sophisticated or savvy people
Yeah.
were running a lot of these businesses, right? Things have become so much more institutionalized and information is more free flowing. There is a lot better comps and data sets, whether you go to, Yardi, or, if you go to CoStar, right? All that information is truly out there at apartments.com. Data is out there enough where you're competing against smart people, and you're paying the most to get these properties. These sweetheart one-off deals, when you talk about 150 plus units, do not exist, because guess who owns these? Really smart people. The way you can capitalize under stress right now is if you actually have the ability to raise some money, and that kind of is a situation where if you can do that, great. But for those who can't raise dollars right now, or for those who are looking for an edge, this is kind of a great way to do it. But maybe you can get an edge because someone put the bad debt and equity structure on a deal. But the other way to do it is, if you have a deal currently and you don't want to sell in this environment, implement something like Neighbor. So with that said, if someone wanted to onboard with a group like Neighbor, this question is going to come: what's the cost, right? What's the fee split?
Yeah, so one of the things I love about Neighbor is we're an entirely performance-based platform. We don't have a SaaS fee. We don't have some fee you're paying no matter what, where you could lose money on this if it doesn't make you money. Instead, it's entirely a revenue share split. And so what we'll do is when you onboard, we'll list your property, and we're going to take like the first month's rent up front to pay back our marketing costs and our uh, basic,
Yeah.
payment processing costs that we incur. But then from then on out, you're going to get the bulk of the funds, and we'll take a percentage of those funds depending on how many properties you list with us and things like that. And but the majority of those funds are going to you as the property owner. And so if we don't bring you renters, we don't make money. And if you make money, we make money. So it's like the perfect incentive alignment. Furthermore, we do a lot to protect you. So we have just like Airbnb, we have a $1 million liability guarantee for you as the owner of the property. We also provide property protection to the renters. I think we're the only storage company in the country that offers up to $50,000 in protection for renters' items. And they can sign up for those plans. Either way, you as the property, you're not liable for their items while they're being stored, which is a great kind of peace of mind if you're a multifamily owner. We take that on for you. The renter, if they have questions, they reach out to us, our customer support team. So we do customer management for you. If for whatever reason there needs to be an eviction of a renter, we'll actually process that eviction for you. We're compliant with storage code in all 50 states, and we have a large legal setup to take care of that. So you don't have to worry about, I got to send the certified mail or whatever. That's all just automatically processed through Neighbor, and we can have a renter out in 30 to 60 days. So it's not like tenant laws where, if they're living in a space, it can take 6 months or longer. Storage is much tighter process where typically within 60 days you can have someone out of a unit in
I
almost
love that.
every
That's
scenario.
incredible. So thank you so much for sharing that. We mentioned before online that you see a lot of market trends and data. Makes sense considering you're kind of looking at a lot of asset classes. For those who you'd be curious by that, what are you seeing in the market right now? What are some of the trends that maybe are getting you nervous, getting you excited? What's kind of your macro perspective right now?
Well, a lot of these are, I don't know that I'm going to say anything that everyone doesn't know. The biggest trend, of course, that started several years ago is interest rates have gone through the roof. Cost of capital isn't what it was before. And all of a sudden, a lot of the buildings that used to make sense, they don't make sense anymore. And that's true. The nice thing is that affected everyone equally. And so the struggles that you're having in your portfolio, everyone else is having in their portfolios. And so it's actually an opportunity. We view that for smart owners as an opportunity. A downturn is a time to shine. It's when some people lose their shirts and the people that stay in, they make a lot of money on the other side when values come back. And so finding ways, even if a property doesn't make sense anymore because your term loan's coming due and the payment is now going to be above where you're comfortable with, find a way to service that payment. Because if you do, again, interest rates are going to reset and you're going to look really good. You just got to get creative. The second trend that, again, I think is fairly obvious, but specifically within multifamily, is there is so much supply. I think 2024 was the most supply
Ever of all time
that's ever
historically,
come
and
on.
supplies, I think all going to be delivered in 25 here. But the drop offs and starts are also very encouraging as well.
Yeah, and so that's the really interesting question. Like it's not an interesting question how much supply is coming on because we all know that. The interesting question is what is the drop off going to look like? And there's some debate out there. I think the prevailing wisdom, but I think it's a little bit of industry bias, to be honest. The prevailing wisdom is it's all going to be great in 2026 because these drop offs are already starting to happen. And so we can tell our investors, trust us, rent growth is going to come back in 2026. Though the one thing I'd caution people on there is, once again, if everyone believes rent growth is going to return in 2026, then you're going to see people start to invest in new builds in late 2025. And guess what that's going to do? That's going to eat up those returns that you thought were going to happen. So there, in today's age of institutional capital, there are not going to be periods of very low building. It's just not going to happen. So adjust accordingly. You should operate as if rent growth is not going to return and make decisions according to that axis instead of banking on something happening in
Correct. And at the
26.
end of the day, I think people are really overemphasizing what could potentially happen. I think people think, historically so much because they've been scarred, rightfully so, probably on the GFC issue. But every recession will look different. Every, part of the market cycle will look different. This one, is actually funny enough, like obviously there's a lot of supply online. Obviously rates have gone up, but performance, generally speaking, and rents haven't retreated heinously in a lot of pockets. Some places are kind of taking the lion's share, whether
Yep.
if you're in a Phoenix, if you're in an Austin, if you're, kind of in the Charlotte, Carolinas, some pockets in Florida, but that's not all equally dispersed throughout the country. And the other thing is to your point, institutional capital and groups of that nature are going to compress pricing. So there's not going to be some easy, you're waltzing into 200 basis points of positive leverage on these deals because there's so many more dollars flooding into this. The market is just more efficient than ever before. And believe it or not, although Rob and I have spoke about this before, sentiment from investors and kind of more retail dollars, which is, call it high net worth individual, kind of fund to fund capital raisers and stuff, that sentiment is at its worst point possible. Why? Because capital calls are happening, foreclosures are happening and whatnot, but institutional dollars are geared up and ready to go to put it in. So the market really actually bottomed in December of 23, January of 24. We're already past probably the low of the marketplace. Believe it or not, wrap your head around that. That is my prediction. But the sentiment from the consumer and the public right now is at its worst, which means probably last year, this year, the next year are going to be the best times to invest. So don't fall into the trap of I only invest when the market's toppy, and then not invest when the market's right now, right? Like that's kind of the fool's way of doing things.
Yeah, that's exactly right. But
Of
easier
course.
said than
Yes,
done.
exactly. The only thing, you don't want to do is get burned by the fire twice, right? So if you had the conviction to invest in deals that were sub 5% cap rates, sub 4% cap rates, well, you should be more thrilled than ever to invest in something that's above a 5% cap rate, right? That's how logic should work.
Well, we see the same thing. I'm a venture-backed company, right? So we deal with the venture capital markets, and you think the same thing would be true. You got this major hype cycle where venture capital firms were investing in companies at 100, even 200x revenue multiples back in 2020, 2021, and now those multiples have compressed quite a bit, and yet you're not seeing venture capital return to the industry. It seems a little counterintuitive. A lot of people got burned. They're sitting on the sidelines. People are a little more hesitant to come back in, even though the best deals of the last 20 years are to be had right now in
Yeah,
the
I've heard there's kind
technology
of a
space.
flight recently from the venture people that I know to cash flowing businesses. Actually, one of my good
Yes.
friends, we both know, of course, has mentioned how he's not getting into the AI world because it's too zero sum. There will be some groups that will kill it, but it's also kind of just a buzzword. But that said, it's perfect segue
Yep.
into the venture capital world. So you mentioned that you've raised a ton of money through the venture world. Can you just talk about the process as to how that works? Maybe looking from capital, kind of getting proof of concept from seed, going from 0 to 1, effectively from no customers to one customer, from kind of getting this that, like kind of how does that whole process intertwine? Because there's obviously the business, which is hey, you got to find people like us, operators, homeowners, people like that. You've got to find customers, then you've also got to find consumers, right? Or there's two sides, there's two product sides, right? There's the renter and the one who rents, right? So can you talk about maybe the process of building up the business from nothing to something, and then raising capital through the process there and what it needs?
Sure. Yeah, so we've raised about $75 million from our venture capital investors. we're based out of Salt Lake City, Utah. So just a brief overview. We raised our seed round from a group, two groups called Pelion Ventures and Album Ventures. Pelion Ventures is the largest venture firm in Utah. And then we really got the proof of concept. We built this marketplace out in Utah. We got a lot of people in Utah using it. And then we expanded to a few more markets. I think Los Angeles and Tampa we expanded to and started having success there. And then we went out to raise what we call our Series A round. That Series A was led by a group called Andreessen Horowitz. And we went after them because they're kind of the premier marketplace investors. Utah does a lot of SaaS businesses, software as a service. And so the investors here have an expertise in SaaS, but we're not a SaaS company. We're a consumer marketplace. So we really wanted to bring in an investor that understood those. We brought in a partner to join our board from Andreessen, he ran eBay North America from 2000 to 2005, so early marketplace. Then he was president of PayPal once they acquired PayPal, and then he was CEO of OpenTable, the restaurant marketplace, took them public. And then now he sits on the board of Airbnb and Instacart and Pinterest and a lot of these other marketplaces. We got him to join our board. So that was I described that to say that's why we decided to bring in that investor at that time. And then fast forward a few years later, we raised our Series B round from a group called Fifth Wall. And Fifth Wall, just like Andreessen Horowitz is a great consumer marketplace investor, Fifth Wall is kind of the world's premier prop tech investor. If you look at all of their LPs, they aren't pension funds and kind of institutional capital like most VCs are. Instead, their LPs are major real estate REITs. And so they have an expertise there. They help partner. So a lot of our partners, Fifth Wall has helped facilitate those partnerships. And we're a property marketplace. So it made sense to get a great marketplace investor and a great property investor on our cap table to help us.
That's incredible. And I've heard in a lot of the times with venture capital dollars that your board is wildly important, and who you take money from an alignment perspective is similarly, one of the more crucial decisions that you can make, particularly with kind of the hands-on process, because it's not that you just get the dollars. Dollars are lovely. We all need to raise money in anything that you're doing, right? But it's also the wisdom, the advice and expertise that comes along with that, and the network, if you will, that's very crucial. And obviously, you mentioned some very reputable groups there. Marc Andreessen's got a very colorful personality and a very colorful view of the world. He seemed to be a lot more public recently, particularly going on Rogan and stuff like that, and has got a very, very active X account, it seems.
That's right. He's his whole life, really, he's gotten more public, I think, recently, but his whole life he's been a disruptor at heart. He has never taken the status quo for granted. I think that's why he's done so well in technology, is that's the idea of technology, is to think outside the box and do new things like Neighbor is doing. We're kind of revolutionizing the way a multifamily property could monetize their space. It's our job to provide that technology and service to make new things happen. To your point, though, it's so important who you bring on, because venture capital is not a short-term investment. This is a 10 to 15-year horizon for any company. So you're going on a very long journey with these people. It's not like private equity where you may be in and out in 5 years, 4 to 5 years. Venture capital has very, very long time to liquidity. And the expectations are very high. Most people don't realize that if you build a $500 million business, that's not interesting to venture capital. Like, that's not worth putting venture capital dollars into. In order to return these funds, so many of their companies go bankrupt because they're taking such extreme bets that they need to believe that every single company could be $1 billion plus company, because it's those small 1% of companies that return their entire fund. And so you should just know, if you're taking venture capital, you're also taking on those expectations that you're going to build a multi-billion-dollar company which it turns out is not easy to do. It's easy to build. Not easy, but like it's easier. It's more straightforward to have a playbook to build a $20 million business or a $50 million business. It's an entirely different world where you have a less than 1% chance of being successful to build these
Yeah,
multi-billion dollar
that's
companies.
really an interesting tidbit there for sure. And as you go through the growth cycle of things, what were those dollars implemented for? What was like the purpose, if you don't mind me asking? Was it for marketing, basically attract
Yeah.
customers? Because the number one thing that I love about your business model, similar to Airbnb, is you don't own any real estate. You have no overhead. It's just pure revenue, right? Assuming that your overhead and base and your advertising marketing dollars, the revenue exceeds that. Well, you've got unlimited, infinite margin, right?
Yeah. Yeah, so it shifts over time what you're using capital for. At the start of any technology company, you're using capital to essentially prop the business up. You don't have revenue to pay for any of your expenses. You're having to make these investments in software engineers and all sorts of overhead to get the business up and running, to be able to run this service and then to be able to run it nationwide. And you don't have the revenue to justify that. As you grow into the business, though, as kind of if you build it, they will come. As you build it and you start to add people to that platform, all of a sudden the revenue starts to outpace the expenses, and you no longer need to raise venture capital to support the business. And at that point, you really shift to raising venture capital to accelerate the growth of the business. So instead of uh, um, capital going into these fixed or kind of fundamental expenses, it starts to just go into growth channels, whether that's sales or marketing. And you say, okay, I know I have a high degree of predictability. I'm no longer in the figure it out mode. I have a high degree of predictability that if I spend, $1, I get back $4. And so I'm going to spend lots of dollars today because I know, a year or two from now, it's going to bring me back those 3, 4, $5. And so you're investing in
Very
growth
cool.
at that point.
Wrapping up here, what is, I guess, the vision coming up here? Like, what are you looking and aiming to do? I know we're kind of coming at the end of time, but what's kind of the next couple of years look like for you, from a goal perspective? Do you plan on ideally taking the company public at some point and having a fat payday, I hope?
Yeah, definitely the goal, especially of a marketplace like this. Marketplaces only really work at scale because you get such a tiny fraction. We take home, unlike many companies where all of their revenue comes to them, we give most of our revenue to you. And so we get this tiny fraction. So you have to be really big. And so it doesn't really work as an acquisition. It's a public company play. So yeah, we plan on taking the company public. We're definitely very focused in the commercial real estate space over the next several years. It's a segment that's growing, I think 4 or 5x year over year for our business. So it's growing quite rapidly. And so we're just going to continue to invest in onboarding more multifamily owners, more retail owners, more office owners to the platform so that we're the largest storage
I love
platform in the
that.
world.
Joseph, you've been such an incredible guest. It's been really fun and inspiring to listen to your journey. We could go on because I have a zillion questions for you, but we'll have to potentially save that for part two. Where can people find you if they want to reach out and learn more about you, onboarding the process, your sales team, the whole nine?
So if you're a small property owner, you can go to neighbor.com. If you're interested in learning more about multifamily, neighbor.com/business/multifamily. If you own a larger multifamily portfolio, feel free to reach out to me directly and I can get you looped into our account services team. It's just Joseph at
Excellent. Joseph,
neighbor.com.
thank you so much for being a guest, such a great guest today. Very appreciative and grateful for your time to learn more about yourself. I look forward to following your journey and hopefully meeting you in person soon here. For those who have listened today, we really appreciate your time and hope to see you next week.